Everyone wants to know the best way to build wealth. But there are so many ways out there. How do we know which one is the best? Well, today we've gathered advice from some of the greatest investors and finance experts of all time. These are their best tips to build wealth, and every single one of them will help you change your life forever. So let's get into the first tip, which comes from the founder of one of the biggest investing giants in the world in Vanguard, John Bogle. His tip is to invest for the long term. He once said, "Time is your friend, impulse is your enemy." What this basically means is to be aware of how temporary emotions can impact your long-term wealth. Emotions and financial decisions tend to be closely connected. After all, your emotions are what drives you to want to achieve your goals, right? The problem is that emotions can cause you to lose sight of your goals completely and drive you to make impulsive decisions when it comes to investments, especially long-term ones, which need time to come to fruition. Let's check out an example of how time can be your friend and impulse is your enemy. Mark and George are two investors who were shocked to see their investments in the S&P 500 crash. During the 2008 recession, Mark panicked and sold all of his investments at a loss. But George stood firm, thought rationally about his long-term goals, and continued investing. Now let's take a look ahead to 2023, where we can see the S&P 500 has fully recovered and went on to experience one of the biggest bull runs in stock market history. Just look at all those gains Mark has lost out on through one emotionally driven impulse decision. But how do I not make impulsive decisions that will hurt my finances, I hear you ask? Well, the best place to start is by working on mastering your own temperament and understanding your behaviours when it comes to making financial decisions. Which takes us on to tip 2. Temperament is vital for success. Peter Lynch, who is arguably the greatest hedge fund manager of all time, once said, "In the stock market, the most important organ is the stomach. It's not the brain." Here, Peter Lynch tells you to take a good look at your ability to remain calm in the face of market volatility. Are you likely to give in to the brain's irrational panic and sell your stocks like Mark did? Or will you have the stomach to sit tight and ride the roller coaster that is the stock market, so that you can enjoy the long-term benefits like George? This takes a lot of work to grasp, because when the going gets tough, your brain will be telling you a lot of different things. Lynch believes that the most important way to avoid making emotional and irrational decisions is simply to have the guts to stick with your long-term investing goals, even when the going gets tough, which is easier said than done, right? When the market hits an unexpected rough patch, it can seem like things aren't going to get any better. But this is where your mindset alone can change everything. This takes us on to tip 3. Have a rich mindset. Robert Kiyosaki, the man behind Rich Dad Poor Dad, once said, "There is a difference between being poor and being broke. Broke is temporary, poor is eternal." One of the biggest obstacles that stops people from building wealth is themselves and their poor mindset. How are you supposed to achieve wealth if you don't believe you can? Change your mindset and get to work making your dreams become a reality. The middle class often argue that investing is very risky because you can lose your hard-earned money. That's a fair point, but allowing your savings to be eaten up by inflation is also very risky, which is why it's important to balance risk. Speaking of risk, tip 4, balance risk. The man behind The Intelligent Investor and Warren Buffett's mentor, Benjamin Graham. Benjamin Graham once said that successful investing is about managing risk, not avoiding it. One of the biggest reasons why people lose money when they invest is because they are taking on too much risk in their portfolios. Even if you do balance your risk, there is still a chance of you losing money. So should you just quit, when you can save your hard-earned money instead? Well, I think John Templeton will have something to say about that, who was named arguably the greatest global stock picker of the century. He once said, "The only way to avoid mistakes is not to invest," which is the biggest mistake of all. But what's Templeton getting at here? He's referring to the fact that not investing at all is a mistake in itself, because you lose the value of your savings each year due to inflation. But inflation isn't the only thing stopping you from building wealth. According to Ramsey Solutions in 2021, did you know roughly 104 million Americans have credit card debt? This leads me on to tip 5, avoid debt. Radio host, finance expert, and award-winning author Dave Ramsey believes the most important key to building wealth is becoming and remaining debt-free. High-interest debt stops people from building wealth over the long term, and these are the debts which people struggle with. Just take a look at this shocking statistic, also from Ramsey Solutions, that roughly 83 million Americans are either struggling or in crisis with their finances. That's nearly a quarter of the population of the US who are struggling and may not ever build wealth, unless they make some radical changes to get out of debt. These changes don't need to be forever though. Short-term pain for long-term gain, as they say. Examples of these changes could be getting on a written budget, cutting unnecessary expenses, or getting a second job. Ramsey goes on to say, if you live like no one else, later you can live and give like no one else. Cutting back to achieve your goals brings me on to my next tip. Tip 6. Live below your means. Warren Buffett's right-hand man, vice chairman of Berkshire Hathaway, and multi-billionaire Charlie Munger, is a huge advocate for this advice because it frees up margin to invest. But let's take a look at what he actually says. He said, live within your income and save so you can invest. If you live on less than you make, it frees up money so you can put towards building wealth. According to Ramsey Solutions in 2022, about 1 in 3 Americans had no savings at all. Freeing up income can be hard when you don't know where your money is going each month. Getting on a written budget is an excellent way to track your income and expenses, so you can make sure you can underspend your income and save and invest for the future. Some of the things I've mentioned already, you might be unsure about, like how to get on a written budget, or which stocks you should invest in. Questions that bring me on to my next tip. Tip 7. Learn about money. This is a tip said from one of the greatest investors of all time, with a net worth of over $100 billion, Warren Buffett. He said, risks come from not knowing what you're doing. Fear of the unknown creates doubt, and with doubt comes risk in your decision making. You can reduce risk by having knowledge. This is the only way to have any kind of confidence in making a decision. Benjamin Franklin once said, an investment in knowledge pays the best interest. The best thing you can do right now is get yourself on a computer, or even go to a library and just start to learn about money. And while you're researching away, I'm sure you'll come across complex words like diversification, which takes me on to my next tip. Tip 8. Buy index funds. Now, this tip is from a guy who created index funds, so he is very biased, but he has a point. Let's have a listen to what he has to say. John Bogle once said, don't look for the needle in the haystack, just buy the haystack. This metaphor is of course referring to the point of an index fund, which is to ensure your money is diversified in stocks amongst various different sectors in one fund. A popular example of an index fund would be the S&P 500. Buffett himself has endorsed the S&P 500, often recommending it to the average investor. In 2008, he famously bet that the Vanguard S&P 500 index fund could outperform 5 actively managed hedge funds over a 10-year period, and he was later proven right. But before we continue, if you're enjoying this video so far, make sure you subscribe to the channel so you never miss a video. Now that you've subscribed, here's a tip that everyone needs to hear. Take responsibility and act. Author Harv Eker once said, the rich believe I create my life. The poor and middle class believe life happens to me. Controversial, I know. It's hard to hear, but it's true. It doesn't matter how many tips you read or how much you learn about money. None of it will make you rich and build you wealth, unless you start taking action. Listen to this. The S&P 500 averages a 10% return. If you invest $500 a month into the S&P 500, within a Roth IRA, you can retire as a millionaire in 30 years. Investment giants like Vanguard and Fidelity offer automatic investment plans, so you can set it and forget it. Even if you invest $200 a month for 40 years, you can still retire as a millionaire. But listening to examples like this won't make you rich. The actions you take can. You've just listened to advice from some of the greatest investors and finance experts of all time. Advice that's practical and logical that anybody could take. These tips are not difficult in themselves. What is difficult, however, is whether or not you're actually going to take action and apply these tips. These tips are the difference between you retiring with nothing or retiring as a millionaire. I get it. The vision is there, but you're still feeling a little lost when it comes to how you're going to get to the finish line. Which is why in our next video, we'll show you a path of how you can become a millionaire.